Disney price fell 58% from the peak. In this case, revenues per share continue to go up, so the business is continuing to grow. It's been mismanaged. Iger is back to fix it, which is why we're interested in the stock. But they continue, as long as you have the top line, you can get someone to fix the bottom line, and that's exactly what Iger is in doing. The bottom line has gotten hurt. It's starting to recover. It bottomed obviously in 2020 when all the parks were closed. Now China's reopening. Now the movie game's back on. They're fixing the streaming. They're going to do stuff with ESPN. They did the partnership with Penn National, etc. for betting. Historically, it's a decent compounder. Of late, it's been an impaired compounder. But this is the key thing. From Oliver Wendell Holmes, the young man knows all the rules. The rules are you buy quality businesses when they're compounders and when they generate a meaningful cash, which just still generates meaningful cash, which is why we're also in it. But it's temporarily impaired, and this is when you want to know the exceptions, because in the case of Disney, no one's going to replicate their parks and no one's going to replicate their content library, and that's when you would make an exception to the rule, looking at it down 60%. It's not many times in history you get to buy Disney down 60%. One of those times was the Great Financial Crisis. It recovered to new highs within 2 years. The other time was the tech wreck. It recovered within about 3 or 4 years, but it certainly recovered, was a double within the first year and a half. So I think we're going to see a similar situation where maybe we get a double in 24 months, and then whether we get to new highs or not is to be determined. We'll see what the business looks like.